Starting in April 2026, new SEC rules will allow brokerages to set intraday margin buying power for any account holding over $2,000. This move effectively bypasses the $25,000 minimum balance requirement that has been the standard for pattern day traders since 2001. While this lowers the barrier to entry for active trading, it also exposes smaller accounts to the structural friction that can prevent long-term capital retention. Most traders spend their entire day researching market direction and perfecting entries, yet they rarely look at the underlying mechanics of how their account actually processes money. That lack of oversight leads to a silent drain on returns, what we call structural friction. This waterfall chart shows how friction works in practice. Even a successful trade is immediately hit by front-end costs, like broker commissions and currency conversions. Once the IRS supplies specific back-end tax traps, your final take-home ROI is only a fraction of the gross profit. To survive as a trader, you must proactively design a low-fee, tax-efficient architecture to defend your net capital. Optimizing the front end begins with your broker choice, which is especially critical for international and Indian traders accessing the U.S. market. Utilizing a global all-rounder like Interactive Brokers, or MEXIM, allows you to secure $0 minimum deposits and keeps U.S. stock fees at or near $1 per trade. However, there is a very distinct trade-off. These low-cost platforms rely on complex, professional-grade interfaces that require significantly more training to master than a typical retail app. In contrast, specialized brokers like TradeZero offer unique tools for short selling, making it easier to locate hard-to-borrow stocks. Choosing that specialized access comes with higher costs. You'll need a $250 minimal deposit and higher per-trade commissions, which can make high-frequency micro-trading expensive. For non-resident aliens, the tax structure is also unique. While you generally aren't required to pay U.S. capital gains tax on stocks, you do face a baseline 30% withholding tax on all U.S. dividends. Managing this drag on your yield requires filing a W-8 and leveraging specific country tax treaties to reduce that withholding rate. The back end of your strategy is where the IRS classifies your behavior, often punishing unoptimized trading patterns with specific penalties. The most frequent trap is the wash sale rule, which is triggered when you trade the same security too frequently at a loss. If you sell a stock at a loss and then buy a substantially identical asset within 30 days, before or after that sale, a 61-day total window, the rule kicks in. This timeline shows the trade-off. You lose the immediate tax write-off. Instead, the loss is added to the cost basis of your new shares, deferring the tax benefit. Fortunately, cryptocurrencies and commodity futures are exempt from wash sale rules, providing flexibility for active strategies. A second trap is the constructive sale. This occurs when you try to lock in a gain by shorting the exact same stock you already own. The IRS views a perfectly balanced hedge as a strategy to avoid paying taxes on a gain without actually selling the position. If you trigger this rule, you are forced to recognize and pay taxes on that capital gain immediately, which effectively penalizes complex hedging in a standard account. Your physical account type actually dictates how your final profits are taxed, regardless of your market strategy. Margin accounts carry a specific risk for dividend investors. By using margin, you give your broker the right to lend your shares to short sellers. If your shares are lent out, you no longer receive qualified dividends. Instead, you receive a substitute payment from the borrower. The trade-off is severe. Substitute payments are taxed at your standard ordinary income tax rate, which can be significantly higher than the favorable rates for qualified dividends. Advanced directional traders can avoid these complexities using Section 1256 contracts, which include futures and index options like SPX. Under mark-to-market, open 1256 positions on December 31st are treated as if sold for tax purposes. The advantage is the 60-40 split. 60% of the gain is taxed at lower long-term capital gains rates, drastically reducing your tax burden. The exact same gross profit faces vastly different tax rates inside a cash account, a margin account, or a 1256 contract. A trader must secure their financial architecture before they can expect their market analysis to yield a net profit. You can find your ideal low-friction setup by mapping your goals through this decision flowchart. The first profile is the advanced day trader. You need leverage, at least $2,000, and a strategy independent of dividend yields. This profile should utilize margin accounts and Section 1256 contracts, combining leverage with the 60/40 tax efficiency to protect returns. The second profile covers international and Indian investors, along with anyone building a dividend-focused portfolio. These traders should strictly use cash accounts paired with a low-fee global broker like Interactive Broker ensures you avoid substitute payment tax penalties and minimizes the friction caused by currency conversions. Do not leave your ROI to chance. Choose your account type, asset class, and platform deliberately to ensure you keep the capital you work to earn.